Welcome to the Phantom Trader world, where clarity comes before execution.
In this explainer, we're going to break down what cryptocurrencies really are. We're going to look past all the speculation and the price charts to really understand the machine running underneath it all. And we're going to start with the single most important idea you need to grasp.
This one idea, right here, is the absolute key to reframing how you think about this entire. It's not about the price you see on a chart. It's about the ledger, the record-keeping system that actually makes the whole thing possible. Everything we talk about builds on this.
So here's our game plan. We'll start by looking beyond the price chart. Then we'll dig into the core problem these systems are trying to solve. We'll cover the blockchain solution, how digital ownership works, and finally, we'll pull it all together into a system-level view for traders. All right, section 1, beyond the price chart. Let's start right there. We need to understand the machine that's actually running underneath all that price action. So let's get a clear definition down. A cryptocurrency is a digital asset that can be transferred on a network without needing a bank, and it's all enabled by a new kind of record-keeping system. Now, notice the key word here, system. The real innovation, the breakthrough, isn't the coin itself. It's the network and that unique record-keeping method that lets value move around without a middleman. And this leads to a really critical distinction you have to make. In crypto, the system is the product. The token, that's just the unit that moves around inside of it. So when you're analyzing a crypto project, you're not just looking at a ticker, you're evaluating a machine. You have to ask, is it secure? How does it function? Is it reliable? The token is just one part of that machine. Okay, on to section 2, the central ledger problem. To really get why crypto systems are built the way they are, we have to go back to the original problem they were designed to solve. And this gets right to the heart of what digital money even is. And the whole thing boils down to this one question. Can we have digital money that works just like cash, but without having to ask for permission from a bank or some other central company? I mean, think about it. With a dollar bill, if you have it in your hand, it's yours. Simple. But online, everything is just data that can be copied. So how do you create a digital version of cash that's truly peer-to-peer? The old way of doing financial system solves this problem with a central ledger, a bank, basically. They keep the official record. But as you can see here, that comes with some major trade-offs. You get security, sure, but you also get central control, a single point of failure, and you always have to ask for permission. The whole goal of a decentralized system is to flip that script and achieve what you see on the right, peer-to-peer, a resilient network, and permissionless transactions. And this brings us to the big one, the double spending problem. This is the absolute core technical hurdle that any digital money has to overcome. Because digital stuff can be copied perfectly, right? So you need a way to make absolutely sure that I can't send the same digital dollar to you and then turn around and send that exact same digital dollar to someone else. Banks prevent this, but again, they do it by being the central authority. All right, so we've laid out the problem. Now for section 3, the blockchain solution. Let's dive into how this new technology actually solves that double spending problem and lets a network operate without a bank in the middle. Before we get all technical, let's just use a really simple analogy to understand the core idea. Think of a shared notebook. Instead of one bank holding the one official ledger, imagine that everyone participating in the network gets their own identical copy of that ledger. So how does this shared notebook actually work? Well, it's pretty straightforward. First, a new transaction gets written down. Then, and this is the magic, all the copies of the notebook get updated at the same time, together. Now, what if someone tries to cheat? What if they try to alter an old entry in their copy? Well, their notebook won't match all the other copies. And so the network just rejects it. It's that simple. This is how everyone agrees on a single shared history of what happened. Okay, so with that notebook idea in our heads, we can now look at the formal definition. A blockchain is basically the high-tech version of that shared notebook. It's a decentralized database that stores transaction data in these linked blocks, making past data incredibly difficult to change. It creates this secure, linked chain of history that everyone can see and trust. But that raises a huge question, right? How do you get thousands of people all over the world who don't know or trust each other to agree on one single version of history? Well, they do it through a process called consensus. Think of consensus as the rulebook. It's the set of rules that lets the whole network agree on what's true and what's not, all without needing a central referee to make the call. Okay, Section 4, Proving Digital Ownership.
We've got the ledger figured out, but how do you actually prove you own the assets on that ledger? This is another huge shift from how things work in traditional finance.
In these systems, ownership isn't tied to your name or your ID. It's all about controlling a secret piece of information called a private key. The easiest way to think about it is this. Your public key is like your email address. It's an address you can share with anyone so they can send you stuff. Your private, on the other hand, is like your password. You never, ever share it. It's what you use to prove you own the account and have the right to send funds out of it.
And that leads us to probably the most famous saying in all of crypto. Not your keys, not your coins. And look, this isn't just a catchy phrase. It is a fundamental technical truth. If you don't have exclusive control over your private keys, you don't truly own your assets. You're just trusting someone else to hold them for you.
All right, let's put this all together in our final section, a trader's system-level view. For any serious trader, understanding this stuff, the mechanics we've just talked about, gives you a way more powerful framework for analysis that goes way beyond just staring at a price chart.
So instead of just asking, is the price going up, you start asking a whole new set of questions. Questions like, what actual problem does this network solve? Who's in charge of validating the ledger? And how do they do it? What are the incentives that keep everybody honest? And maybe most importantly, where does the trust system actually come from? When you focus on these questions, you start to see the difference between real, fundamental value and just, market noise.
Now, there's a really important implication to all of this. The rules of finance haven't been removed. They've just been moved from people and institutions into software code. And what that means is that these systems can be completely unforgiving. The rules are enforced by code, not a person you can talk to. Transactions are usually irreversible. Mistakes can be permanent and very, very expensive. There is no customer service line you can call when you mess up.
So this is the big question I want to leave you with, the one you should carry forward from here on out. Are you analyzing the price, or are you analyzing the machine? Understanding that distinction, the difference between the price, which is just sentiment, and the machine itself, which is the actual product, that's the real foundation for any serious analysis in this entire space.
If this video added clarity to how you see trading, support this work. An interaction tells the algorithm this foundation matters. A subscription tells me to keep building it with you.